Hello and welcome to CMC Markets on Tuesday the 26th of November and the weekly market update. And I really ought to copy and paste the first part of this update, because every week I seem to be saying the same thing. Weekly record closes on the Dow, the S&P and the DAX. And the key question, I think, at the forefront of most investors' minds at the moment is really whether or not, given the gains that we've seen so far this year already, is whether or not we will get a Santa Claus rally heading into December and in the lead up to Christmas. Well, let's address that first thing right off. Let's look at the S&P 500 daily chart, because we're heading into the Thanksgiving break in the US. I think volumes are likely to get thinner as the week goes on, and the prospect of further highs above the current highs of around about 1810, you have to think are likely to be fairly low. Having said that, there's always the possibility that we could continue to go higher, really more than anything on a lack of inertia than anything else, or a lack of particular selling interest. But let's look at the S&P chart and look at where the key support level is. And we can see straight away it's around about the October highs, drawn a horizontal line straight through those highs, and it comes in around about 1775. And when I was talking about how the S&P was moving an awful long way from its 200-week moving average last week, I identified that 1775 level as a key support level. We did indeed go back and test it, but we were unable to break below it. So that for me at the moment is the key support level on the S&P. A whole host of other data out later this week. Not least, we have the UK GDP. I'm going to have a quick look at the pound against the dollar at the end of this particular update. But more than that, I'm going to actually focus on the Australian dollar, because I think when you're looking at charts, I think sometimes it helps if you actually are able to strip the chart back to its bare essentials. Now, an awful lot of my charts on my platform have an awful lot of trend lines, moving averages, old trend lines drawn on them. And sometimes it's very, very difficult to see the wood for the trees, if I can use that analogy. So sometimes I think it helps if you're able to just strip the chart all the way back without actually deleting all the lines that you've got on your chart. So the chart I'm showing you at the moment is a daily chart. It's got a 200-day moving average. It's got a whole load of Fibonacci retracements on it. And it's also got a slow stochastic. Now, I've been saying for some time that the bearish engulfing day that we saw when it hit the 200-day moving average was a fairly good warning that we were going to get a bit of a pullback. But of course, with all those lines on those charts, I actually failed to see quite a nice little pattern. So just by pressing a single button on the bottom of, or just above the series of menu options at the bottom, you can actually hide all the analysis without actually deleting it. And this is the chart that you get. Okay, so I've stripped it back to that chart. It's just got the 200-day moving average on it. Now, can you see the pattern that I've missed? Because it's not immediately apparent, but sometimes when you look a little bit closer, you can see this. Now, can you see what I'm driving at? It looks like a head and shoulders reversal. Now, in amongst all the lines, the moving averages and the oscillators, I actually missed that. And I've only just spotted it in the last couple of days. We've broken below the horizontal support and resistance line. And as long as we stay below that support and resistance line, then there's a fairly good chance we could well see a retest of the lows that we saw earlier this year. So really, a note to self, it's always a fairly good idea sometimes when you've got an awful lot of trend lines on your analysis, an awful lot of Fibonacci lines and what have you, to just briefly hide them, have a look at the underlying price action to see if there's anything that you could have missed that you actually can't see because of the existing lines on the graph. To reinforce the weaker Aussie theme, I'm also going to show you an Aussie Kiwi chart, because I think one of the key factors that drives the Aussie is its relationship with the New Zealand dollar. And we can see from this chart that's in front of us right now that the Australian dollar has broken a very key support level against the New Zealand dollar. And that would seem to suggest as long as we stay below that now resistance line, It was a support line, it's now a resistance line. As long as we stay below that resistance line, then we could well see further significant Aussie weakness, and we could certainly see that the Aussie will fall an awful lot faster or outperform the New Zealand dollar. So I'm going to finish up with the pound against the dollar, one of my favourite currency pairs, despite the fact that it can actually be very unforgiving. We've got UK GDP, Q3 GDP out later this week. Not really expecting too many surprises there, expecting that to come in 0.8%. What I'm particularly going to be looking for in those set of numbers is whether or not the business investment number actually improves, because I think if we're going to see sustainable growth in the UK economy, then that is one of the key, I think that's one of the key components that really needs to improve. I digress slightly. Let's talk about the 280-point price band that cable's been trading in since the beginning of October. The top of that band is around about 162.50, 162.60. The bottom of the band is around about 159.60, 70, give or take a few pips here or there. Now, we've seen a bearish engulfing candle on the daily charts, which would appear to suggest that we could well see a retest back within the current price bands that I've actually drawn on the charts in front of you. Bearish engulfing day could see a pullback to the 161.10 level. If we break below the 161.10 level, then there's a good chance we could go back to retest the bottom of that sideways price action around about 159.80. Now, when you actually look at the oscillator as well, that's looking a little bit overbought. It's starting to turn over. We've also got trendline resistance from the 2009 highs at 170.45, which comes in above 163. So even if we break above the 162.50-60 area on the top side, we've also got significant resistance coming in at 163. So it's going to take something fairly substantial to move cable out of its current range as we see it at the moment. Okay, so that's pretty much it for this week. Once again, thanks very much for listening. Don't forget, we've got an active trader workshop this Friday at 10 o'clock, so please feel free to sign up for that. There's a link at the bottom right down here. Until next week, thanks very much for listening. This is Michael Hewson talking to you from CMC Markets.